going to start with the IFRS. And now we have to, before starting the analysis of the particular standards about tangible assets, intangible assets, and so on, we need, first of all, to dedicate some minutes to a very important concept, that is the fair value. This is because under IFRS, fair value is one of the possible measurement bases used by that it is possible to use. And so it is important to know the meaning of fair value and also the advantages and disadvantages compared to the historical cost. So in this slide, we start with the same chart that we saw yesterday, with the measurement basis allowed by the conceptual framework. Keep in mind that the conceptual framework is not a standard, so it's not the framework that defines when the fair value, the historical cost, and so on must be used. The framework simply states that there are many important measurement bases. The first type of measurement basis are the historical values, and in particular the historical cost. And in a few minutes we will use the historical cost for tangible asset. It is possible also to use the cost for financial instruments, and in this case, the cost, the criterion is called amortized cost. So pay attention. This could be misleading, but the historical cost is used for tangible and intangible assets, for inventories, and so on. Amortized cost, pay attention, is not used for tangible and intangible assets. Amortized cost is used for financial instruments. And we will discuss it at the end of the next week. But at the end, also the amortized cost, the basis is the cost paid by the company. It is possible, according to the framework, to use other values based on the current values. So in this case, the historical amount paid in order to acquire the asset is not taken into account. In this case, we focus on the current value of the asset. Current values can be entry value or exit values. What is the difference? If we have an asset and we need to determine the current value of that asset, for example, at the end of the reporting period, at the end of December, the current value could be an entry value. So we, in this case, we try to define the so-called replacement cost. So the amount that the company should pay today in order to replace the asset. Entry, because it's a value based on the amount of money necessary in order to buy again the asset. The exit values are completely different because, of course, they are current value at the end of the reporting period. But in this case, we look for the amount that the company can collect from the sale of the asset. Exit value, sale of the asset. Okay? So it's not based on the amount that the company has to pay in order to buy again the asset, but the amount that the company could receive if the asset is sold at the end of the reporting period. The exit values can be based on the market or can be entity specific. When the exit values are based on the market, in this case, this value is called fair value. The fair value is an exit value based on the market, and the market is the same for all the companies. Entity specific values, this means that they depend on the single specific company. Today we focus on the fair value. In probably, I don't know if Friday or at least next Monday, we will learn something also about the value use. The value use is one of the possible measurement for impairment test. So when the company has to verify if the value of an asset is still recoverable or not. Today we focus on fair value. I repeat again, it's a market-based value. Fair value is important under IFRS, and it is defined in a specific standard, that is the IFRS 13. Please read the definition. Fair value is the price that will be received to sell an asset, or the price that will be paid to transfer a liability. Exit price. Okay? Price, market, exit, because it's a price that the company can receive in order to sell, to dispose of the asset, okay? Or to transfer the liability. So the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participant and the measurement date. Measurement date means that the fair value measured today is different compared to the fair value measured tomorrow, or the fair value that the company measured yesterday. Okay? Because the fair value is the market value. This is particularly true if you think about financial assets. Okay? The price of financial assets changes not only every day, every minute. So it is important to define when the fair value is computed. Exit price, and it is necessary to take into account the characteristics of the asset or the liability. So if we need to determine the fair value of an asset, first of all, we need to understand the characteristics of that specific asset. And the market. Okay? So it is based on the price that will be received in a market transaction. Orderly transaction means that, for example, the seller is not forced to sell. Because if someone is forced to sell, it is highly probable that the price is not fair. Because if I need to sell sometimes very quickly, I accept to receive also a lower amount of money because I prefer to have the money quickly compared to wait some months in order to obtain a fair value. Okay? So the fair value is based on market and is determined, having in mind orderly transaction between market participant. Market participant, they know exactly the characteristics of the asset, the characteristics of the liability. There is a question. The buyer, the same. Okay, so also the buyer, also the buyer should be free to put in place the purchase. I highlighted the seller because generally speaking, it's the seller that can be forced to sell because of regulations or liquidity problems. But it's exactly the same. The buyer and the seller, both, they must be free to put in place the transaction, because if they are free, they agree on a price that is a fair value. Thank you for your question. This is an exit price. Of course, it depends on the perspective. But from an accounting point of view, when the fair value is determined for an asset that the company has, in this case, is the exit price for the seller. Okay? So for the buyer, of course, is the entry price, so the acquisition price. But in the perspective for accounting perspective, for asset, it's the price in order to sell the asset. Of course, for the other party is the buyer, the entry price. You're welcome. And for some assets, it is quite easy, very easy to determine the fair value. Because if the assets are quoted, listed in a market, like for example shares that are listed, it's very easy to find the fair value. Very easy because it is sufficient to look at the prices of the market. In this case, the fair value is determined according to the level 1. Okay? Level 1 means that the company does not estimate the fair value. The company simply reads the market price. The market price is available because the asset is exchanged in the market. So it's easy to determine the fair value. No estimates, level 1. Okay? And this is the case, for example, of all the assets. Now I switch to English. Okay. Okay, English. This is the website of the Italian Stock Exchange. And here we can see the list of all the shares, bonds, and other securities that are listed. So it's quite easy. For example, here, the letter C, we can see, for example, for Campari, this is the price at which the shares Campari is now traded. Okay, this quotation is not exactly the quotation that is in this at 10:48. There is a delay. But this is the fair value, the market price. Is this clear for everybody? So if a company holds shares of Campari and according to IFRS, the company has to use fair value in order to measure that shares, that company uses a level 1 fair value because the shares are listed and it is not necessary to make any estimate, no assumptions. Okay? Is it clear for everybody? But there are other assets and also liabilities that are not quoted, are not listed. And according to IFRS, some of these assets must be measured at fair value. So if they are not listed, it is not possible simply to see the prices in the website like I have just done. But it is necessary to determine the fair value using some valuation techniques. Discounted cash flow techniques or Black-Scholes option model and so on. When we determine the fair value using evaluation techniques, the problem in many cases is not the techniques. Present value, for example, of the future expected cash flow. Present value is a very simple technique. The problem is not the technique, that is a mathematical formula, but the problem is the input that we use for that formula. For example, if the fair value is equal to the present value of the future cash flows, the problems are the future cash flows and the interest that the company has to use in order to compute the present value. Is this clear for everybody? I don't know your background in mathematics. I hope that it is good enough. Mathematics, and in particular financial mathematics, is very important. Here what is important is that if the asset is not traded, the company cannot use the level 1 in order to determine the fair value. It is not possible. But it is possible to use techniques in order to simulate the fair value. The fair value is the price that will be received to sell that asset. So it is possible to use a mathematical formula that simulates exactly the price that the market participant would accept as a fair value at the measurement date. These valuation techniques can be very simple, present value, or more complex, Monte Carlo methods, Black-Scholes method, and so on. But at the end, simple or complex, the mathematical formula is a formula. We need to substitute to that formula the inputs, future cash flows, the interest rate, the foreign currency, the price of oil, and so on. So the problem here is about the inputs. If the inputs are observable in a market, fair value is level 2. Otherwise, level 3. What is the difference? Suppose that a company has to determine the fair value of a financial instrument. For example, a derivative. could you please give me some example of derivative? Options. Okay, Elena. Futures, forwards, swap, financial instruments, okay, based on foreign currencies, interest rate, commodity price, and so on. Futures are listed. So if a company has a future, the determination of fair value is very easy because futures are listed, so level 1. Most of the derivatives are over the counter. That means that are not traded. So the company needs to determine the fair value using evaluation techniques. The valuation techniques, for example, for a forward is just one. At the end, it's a present value. A little bit complex, but the present value. The problem is that when I compute the present value, I need to use an interest rate, a foreign currency, and if I can obtain those inputs simply looking at the market, this is a level 2. Yes, there is some subjectivity, but very small, because we agree on the valuation techniques, the present value. And if the inputs are observable in the market, this means that if I compute the present value, or if you compute the present value, first, we use the same valuation techniques. Second, we use the same inputs. So what about the result? The fair value will be the same. Do you agree? So level 2 means that the asset is not listed. We cannot simply read the fair value, we need to compute the fair value. But if the valuation techniques is to be used is the same, because it's and not complex instruments. And if the inputs are observable in the market, at the end, 10 different companies, if they compute the fair value of the same, I don't know, forward, with the level 2, the result is the same, because the valuation techniques is just one, and the inputs are the same for all the companies. Level 3 is a little bit more complex and critical, because sometimes the valuation techniques is known, so we agree on the valuation techniques, but the problem is that the inputs are not observable in the market, so each company has to estimate the inputs. And this means that if company A makes this estimate, maybe the result is different compared to the estimate made by company B. Is this clear for everybody? So fair value is used under IFRS, is very important. It is not the only criterion. Some assets must be measured at fair value. For some others, it is forbidden to use fair value. For some other assets, it's the company that can choose between historical cost and fair value. Anyway, when a company has to use fair value, the company has to apply this hierarchy. So if the asset is listed, it is mandatory to use the market price. Otherwise, it is necessary to determine the fair value using a model